summer. So, hi, good to see you. Welcome. Can you, to the new arrival, can you put on a thing like this so I know your name? Is there a reason why you're all in this part of the? I mean, it's nice. I can sit on this table and talk to you, but.
It's okay. There are people there, but.
I see. They're not yet.
Yes.
I see. Okay. Good. Okay. I don't mind. It's fine. I mean, it works very well, and I very much enjoyed the morning. So we had a good start. Hopefully, you enjoyed it as well. Okay, scroll. And all right. So welcome back and welcome. So your name is? Okay. Dui.
You can call me Money.
No, I call you Dui. If that's
Doing.
Dui.
Yes.
Okay. Dui.
Yeah. Oh, I think you can learn try.
Okay. Dui. Pardon? I have?
Because a lot of foreign person cannot learn like you.
Yeah.
Yeah, they try but they cannot. So,
Okay. Well, I learned a lot of languages in my past. So I learned English, French, Italian, Russian, and Polish, and I love. I mean, it's yeah. But okay, doing. Okay. Yeah. Thank you. Okay. So let's continue, and we keep deviating from my plan, but it's okay. I think, given that you had essentially no time for the transition from Mike Halyas's course to mine, I'm going into this balance of payments presentation, although I told you to prepare it beforehand. But I think if we skip this will eventually backfire. And I tell you, at the end, when you go to whatever position you want to take, right, be it in policy, be it in research, being insecure about the data and how to interpret the data is a big drawback. And so I think later on we go into theory and we model things, but we always have to have this balance of payments framework in the back of our mind. So I think it's well invested time. So let me come to the next thing. And Dui, I'm sorry, we spent a morning on the balance of payments. You just have to check the presentation. I'll just take it from here. So I'll talk about the next thing, which is the so-called net international investment position. Now, this morning I told you, when you have a bank account, you have the amount that you have on the bank account at the beginning of the month. Right? And then you have inflows, outflows, and then you have the amount on the bank account at the beginning of the next month. Now what we're talking about now is kind of a national bank account, right? Kind of the stock of assets minus liabilities at a given point in time. And the logic is that we start at the beginning of, say, 2024. Then we have all these current and financial account transactions in 2024, and that determines the net international investment position at the beginning of January 1st, 2025. Right? It's like you start at the month, then you have inflows, outflows, and then you have, you know, the bank statement at the beginning of the next month. So this is what the net international investment position is. There's much more to say about this, but let's build up the thing from scratch. So remember, balance of payments equilibrium period T, when you ignore the net errors and omissions, says that the current account and the capital account balance added up should be equal to the financial account balance. So if you're running a current account surplus, let's forget about the capital account, then you're accumulating, then you're increasing the stock of assets minus liabilities vis-a-vis the rest of the world. Germany running a current account surplus by exporting more cars than importing referee whistles is getting UK liabilities in exchange, and so increasing its assets vis-a-vis its claims vis-a-vis the rest, vis-a-vis the UK. Good. So the balance on the financial account, FA, is the change in a country's net international investment position. And this thing we'll see over and over again, right? So the financial account in T, so that would be the financial account in 2024, gives you the change in the net international investment. And BT is the, I'm adopting notation from my textbook and also from Obstfeld and Rogoff's book, this is January 1st, 2024. This is January 1st, 2025. This is the financial account in 2024, right? So this is, okay, so importantly, and this is not obvious, you have to define it, this is at the start of period T. So that would be, if this is the year 2024, it would be January 1st, 2024. And so if you're running a financial account surplus in 2024, then the net international investment position at the beginning of 2025, so in January 2025, should be higher than the net international investment position at the beginning of 2024. Okay, so that's the logic. Now, combining these two things, so replacing the financial account by the current account and capital account, says that the current account balance plus the capital account balance should be reflected by the change in the net international investment position. So if a country is running a current account surplus, it is accumulating assets vis-a-vis the rest of the world, so the net international investment position is increasing. So I can pull that out of my ear. Okay. Now, I'm fine. I'm just very careful about, you know, the temperature changes, and I'm still kind of jet lagged. So you have to be a bit careful about, you know, your health. But I think I'm good. Okay, now two things, and these are very important, although they are sometimes glossed over in textbooks. The first thing is, some institutions use the term net lending or net borrowing for the sum of the current account and the capital account balances. So, in fact, the IMF does it, the ECB does it and says this is called net lending or borrowing. It's net lending when it's positive, it's net borrowing when it's negative. There's a problem with that. Why? Now let's develop this. If you're lending me 100,000 Vietnamese dong, which is not too much, but if you do that, what do you expect me to do? Suppose I realize I want to buy fruit and I have to pay in cash and I don't have any cash and I ask you, can you lend me? It will not happen. But I say, can you lend me 100,000 BND? What do you expect me, what do we have to clarify in advance? When will I pay back? And what's the interest rate? Right, okay. Now, suppose we suppose you lend me 100,000 Vietnamese dong, and we agree on an interest rate of 5% per day. Okay, and I agree. What will happen to, suppose we do that now, right? What will happen tomorrow? Well, you come to me and say, look, can you please repay 105,000 Vietnamese dong because you borrowed 100,000 plus 5%. That's, no, lending works this way, right? It's you borrow, you get the money today, you repay, and there's no discussion about how much I have to repay because it's fixed. Okay? So that's a lending contract. Now, the point I want to make is not every liability is a loan on international financial markets. That's the big point. And this is why net lending is because foreign assets and liabilities consist of assets where the payments are not state contingent, so they do not depend on whether I'm having a good day or a bad day, or whether I'm in good shape or in bad shape. Right? If you borrow money and someone else lends you, that person doesn't care. Right? If I borrow money from you, so if you lend, I borrow. If I borrow money from you, I have to repay what's due. Right? There's no discussion. That is lending. That's debt. So payments are not state contingent. Creditor is entitled to receive pre-specified amount, principal plus interest, at maturity. Right? When the loan is due. That would be, in our case, would have been the next day. Now, equity works differently. So suppose I do not borrow money from you, but I want to have 100,000 Vietnamese dong and you to participate in my company. And you become a stock owner. Right? Then how much you get out of this does depend on whether the company is run well or not, and whether the business goes well or not. And if the business goes well, you might get a lot out of it. And if the business is not run well or the situation is difficult, you may not get anything out of it. Actually, you might use your entire money because the company goes under. Now, in international financial markets, we have debt-like contracts, loans, and we have equity-like contracts where the payment is state contingent. State contingent, it depends on the situation, right? Equity, you put your money into the company as an equity owner, and if the company goes well, you become rich, and if the company goes under, you lose your money. I mean, that's what you learn in finance. And so, the term net lending, borrowing, suggests that everything is just about debt, and that's wrong. And I show you that it's becoming more and more wrong, or it has become super wrong. Because trade in equity sustains international risk sharing. In what sense? Let's go to Thailand. When someone wanted to have foreign money in Thailand in the mid-90s, he had to borrow in the narrow sense of the word. So you borrowed money, and that meant you had to pay it back, no matter how well the Thai economy was faring. This implied, of course, that Thailand was very exposed to a lot of risk, because if Thailand was in a bad situation, it had to repay those loans anyway. Now, if a country, make it Thailand, manages to attract equity-like liabilities, then this problem is not there, because the foreign investors share part of the Thai economy's risk, right? Because they don't get a pre-specified amount of money. They get a lot when it's run well, when things are good, and they don't get very much when things are bad, right? So they participate in the local economy's ups and downs. And so the term net lending, net borrowing is misleading because it suggests that this is all about loans. It's not. And this is just to show you, we've talked about Thailand, the net international investment position of Thailand then and now. So this is 2000, this is 2023. You don't see very much here, which is intentional because international financial markets were not as developed in 2000 as they are today. Meaning that compared to what we have today, or in 2023, the volume of assets and liabilities in Thailand was very small. But what you see is in 2000, foreign assets of the Thai economy, and we're talking about individuals, we're talking about firms, we're talking about the government. Foreign assets were smaller than foreign liabilities. And most of the liabilities were other investment. Now, other investment means bank loans. Okay? So that's, and a bank loan, I mean, you borrow from a bank. Suppose you borrow a large amount at an interest rate of 5%. For maturity is a year. In a year, the bank comes around and says, by the way, we want to have our money back, plus interest. And when you say, oh, I'm sorry, I'm in bad shape, and I basically squandered your money, then you're taken to courts. You have a major problem. If you take the money from an equity investor and business doesn't go well, then I mean, it's your problem, but it's also the equity investor's problem. Because, that's exactly what what we see that in moving from 2000 to 2023, in Thailand, first of all, by now, assets are larger than liabilities. Secondly, we're talking about much higher volumes. And we're talking about FDI and portfolio equity being much more important. So FDI is equity type liability, right? So someone puts your money into a Thai economy not as a loan but as equity. That means there's no pre-specified sum that the Thai firm has to repay. It's just the profits. And if things go well, then profits are high, and if things are bad, then profits are low. And this is also something that you can see on the next slide. This is 2000, assets and liabilities. Let me focus on the liabilities first. In 2000, something like close to 60% of Thai liabilities were other investment, bank loans. In 2023, it's just about 20%. In 2000, the equity component was something like 35% if you combine FDI and portfolio investment equity. In 2023, 70% was equity investment. So the type of liabilities has changed dramatically for Thailand. And in fact, this is something that we observe for a lot of economies, not just for Thailand, also for Vietnam, by the way. What you also see is that the assets of Thailand were in 2000 were essentially the 60% were reserves of the Central Bank of Thailand. By now, those reserves are about 35%. By now, we do have Thai FDI assets. So it's no longer the case that there's rich economies doing FDI in poor economies. There's middle income countries like Thailand doing FDI in other economies as well. I mean, there's China doing FDI in Germany. That's the way it is, right? So if you go to undergrad textbooks and you learn about international finance, then these are the little things that are swept under the rug. And that's dangerous because you completely misread what's going on in financial markets when you ignore the shift from debt finance towards equity finance. And that holds for a lot of emerging markets and developing countries. It doesn't hold for every country. So I taught a course in Guernsey to my central bankers a month ago. And there was a person from Tanzania in Africa and said, this is not correct for my country. And then I went to the data and said, yes, it is. So even the central banker from Tanzania wasn't aware of this development. So that's important. Next thing. By the way, where do you get data on countries' net international investment positions and the composition of these NIIPs? Well, you get them from the IMF balance of payment statistics. In fact, you get them from it's called balance of payments and international investment position statistics. And you get them from this data set, which is two people I know, actually, Phil Lane and Gianmaria Milesi-Ferretti, who produced a very influential paper in 2001, where they introduced a data set on countries' external assets and liabilities. And the good news is it's available free of charge, so you don't pay for it. You get it. Good. Now, let me continue and highlight another thing. Equation 2.6 implies that the net international investment position in T plus 1 is the NIIP in period T plus the current account and the capital account. So you start on January 1st, 2024. You add the sum of the current account and the capital account in 2024, so all transactions between January 1st and December 31st, and that gives you the net international investment position at the beginning of period of January 1st, 2025. Okay? It's like you start the month with 1,000 Vietnamese dong, which is, okay, let me make it 100,000. You start the month with 100,000 Vietnamese dong, you add 10,000, you start the next month with 110,000. So, this is the United States, current account plus capital account and the NIIP. The current account and capital account is measured on the left axis, and the net international investment position, assets minus liabilities, on the right axis. Now, first thing, you may have not known that, but United States has much more the US liabilities are much higher than US assets. That's the way it is, right? Is that a bad sign or a good sign? I would say it's a good sign for the United States because it means that people are willing to hold US assets. And the current American government is doing its best to destroy that privilege, right? That's a very dangerous thing. Because if you start talking about you want to tax foreign central banks' holdings of US dollars, those central banks at some day will say, you know what? We don't need that stuff, take it back. And then it will be very difficult for the US government to finance on such favorable terms as it used to in the past. So that's my little policy remark here. You also see that the current account plus capital account in the United States, starting in the early 90s, were notoriously negative. That's the left-hand side thing. We're talking about, at times, minus 1,000 billion US dollars. Right? So it's not surprising that the net international investment position went down. So you're running current account deficits, dragging down the NIIP. So the NIIP, the negative NIIP that we observe today, is a consequence of United States current account and capital account deficits of the past 30 years. Okay, so it's now, however, there's something that is weird, but not weird, but not really weird, but interesting. So let me write this equation again. CAT plus KAT. And that's equivalent to saying the change in the net international investment position is equal to the current account plus the capital account balance. So if you add the current account plus capital account balance, you should see the change in the NIP. Now, this is exactly what we do here. So the red line is the change of the NIIP. Now, you see that until the early 90s, or actually the mid-90s, by and large, these lines were on top of each other. Starting in the 2000s, they're no longer. So there are years when, for example, in the year 2022, when the sum of the current account and the capital account are negative, and still the NIIP goes up. Now, what the heck is going on here? Why is that? Now, let me give you an example to explain. Suppose you are holding, you have a savings plan, and you're saving by buying an investment fund. You know what an investment fund is, right? It's a mix of equity. Suppose you have, let's turn to the dollars because these Vietnamese dong numbers are so large. So suppose you have at the beginning of the month, your portfolio is worth $10,000. During the month, you're adding 1,000. How much do you have at the beginning of the next month? Now think about, are you sure that's the case? Think about what happens. We're talking about an investment fund. What can happen to the investment fund during the month? The value can fluctuate. So it might be that you start with 10,000, you add another 1,000. At the same time, the value of your existing portfolio goes up by 1,000, so you end up with 12,000 instead of 11,000. It might also be that the value of your portfolio goes down by 2,000, so you end up with 9,000 instead of having 11,000. So there's valuation changes. When we talk about foreign assets and liabilities, we have those things coming from the financial account, which is transaction-based, but you also have valuation changes. Because we're talking about assets and liabilities whose value is not constant. And that's exactly what Lane and Melesi Ferretti highlighted. They said, look, we have to take this seriously. So in that year 2022, apparently, while the United States were running a current account deficit, at the same time, the value of their assets increased big time, or the value of their liabilities decreased big time, or both things at the same time. Right? And this is driving this discrepancy. It's so-called valuation changes or valuation effects. And this has become more and more important over the last decades, and it's something that has to be known and has to be acknowledged. So the observation is that there's an increasing difference between the current account and the capital of the sum CA plus K and changes in the NIP. And the reason is, well, one reason could be net errors and omissions, but the other reason might be so-called valuation effects. So the change in the value of the existing assets and liabilities, like if you hold a portfolio of an investment of equity, this goes up and down, right? No matter how much you pay in and how much you take out. So this is the net capital gain on existing foreign assets and liabilities, and those sources of capital gains and losses are exchange rate fluctuations and movements in asset prices, bonds and equity. Right? So this is part of one of the. Okay, so that is something that when you talk about the NIP, it is something that those valuation effects, they are important. And we'll talk